If you are new to Orderflow, this is going to be the only video you need going over one of the main tools, also known as the footprint chart. I will be covering what it is, what it shows, and how to utilize it. So let's begin. Before we talk about Orderflow, footprint charts, any of it, we need to talk about what the market actually is. Because most traders treat price like it's just a line moving up and down on a screen. But it is not. It's real people with real money and is built on actual supply and demand. Every single tick you see on your chart is the result of those buyers and sellers interacting with each other. So let's start there. Who is actually in the market with you? There are two types of players. Aggressive players, those with market executions, and passive players, those with limit orders. In order for a transaction to be successfully facilitated, aggressive players have to be paired up with passive players. So, if an aggressive buyer wants to market execute, there has to be someone on the opposing side willing to sell to them. And that opposing side comes in the form of sell limits. So the aggressive buyer, the aggressive buy order has to be paired up with a passive sell limit order. Same thing, vice versa if it is an aggressive seller. The aggressive seller, in order to sell at market price, there has to be a buyer who is willing to buy from the aggressive seller in the form of a passive buying limit. And once you understand those two players, this brings me on to the depth of market. A live snapshot of every resting order on both sides of the market at the exact moment in time. And I want to walk through this carefully because most people have actually never looked at one of these. But this is what's happening behind every single candle and behind how the market actually moves price. So on the left side, which is your bid, these are your buy limits. Buyers who have placed limit orders here said, I want to buy NQ or whatever asset you're trading, but only at this specific price. They are not buying now, they are waiting. So the top of the bid, or the price closest to the last traded price, this is called the best bid. Right here at 21049.75, there are 156 contracts sitting here. 156 contracts worth of buyers who said, I will buy, but not at more than 21049.75. And on the right side, which is your ask, same thing as your bid, but on the opposing side, your ask is what you would have guessed your sell limits. So these are sellers with limit orders saying, I want to sell, but only at this price or higher. The closest one to the market and the last traded price is your best ask. So that is 21050.25. 89 contracts sitting here, 89 sellers who are willing to sell, but not for less than 21050.25. The gap in between, from the best bid to the best ask price, that is known as your bid-ask spread. Because no buyer is willing to pay 21050.25 and no seller is willing to accept 21049.75. They haven't agreed. So the last trade that happened was at 21050, right there. And that is our current price. That is where buyers and sellers last shook hands. Now, how does the price move from 21050 to somewhere else? Because this is the part that most traders have completely backwards. Price moves when one side decides to stop being patient. When a buyer decides, I can't wait anymore, I need to get in now, they don't place a bid below price. They reach up and buy from the seller who is already waiting. And this becomes known as your market execution at market price. So they hit the best ask. They buy at 21050.25. Assuming the buy order is more than 89 contracts, they would have consumed the 89 contracts sitting here. So 89 contracts gone and consumed. So the sellers who placed limit orders at this level has been fulfilled by the aggressive buying participant who bought at the best ask price. Now, the new best ask price has shifted to 21050.50. Not because someone said it should go up, not because a pattern formed, but because a buyer was aggressive enough to consume the available supply at the level below it. And price has had no choice but to move and find the next seller to fulfill any new demand from buying. If this keeps happening, if aggressive buyers keep reaching up and taking sellers, they will work through this level, and then this level, and so on. But we eventually, and this is something really important that you have to note, we eventually come into a level where there are 445 contracts at level 21051.25. The bar here is significantly greater than the neighboring bars. Because what does this represent? This represents a wall or a cluster of sellers. They have placed 445 contracts at this level. For price to move through 21051.25, every single one of those 445 sell limit orders have to be consumed. That takes a lot of aggressive buying. If the buying pressure that got us through all of these levels previously, if it isn't enough to do that, then price will eventually stall at this level, it will pause, and maybe it could potentially reverse. And that is something I will be going into further detail later on in the video, so make sure you carry on watching. But the main idea behind this is, if there is more supply, then there is demand willing to pay at that price, then the market won't move. The market only moves to facilitate supply with overwhelming demand. If there is more demand than supply, then the market will move. And that is why certain levels hold and certain levels don't. It's not support and resistance drawn on a chart. It's actual real supply and demand. Real contracts and real participants who have decided that this is the price they want to transact at. Now, if you have a look at scenario 2, where sellers take control and price starts dropping, it's the same idea, but it's just in the different direction. So aggressive sellers start hitting the bid at the best bid price, and they sell into 21049.75, taking the 150 contracts sitting here, assuming that their sell orders are more than 156. If it isn't more, then price can stay at this level because the supply is sufficient enough for the demand. But if the demand is more than the supply, so if aggressive sellers now have more sell contracts placed than 156, then this will be consumed, this level will be consumed, and then the next best bid price becomes 21049.50 at 234 contracts. Eventually, if sellers are still in control, they will work through this, placing more than 234 contracts on sell orders, and then this level will eventually become consumed, moving on to 21049.25. So this is the new best bid price, but notice here how on the bid side there's only 89 contracts. The same strength that was required to break through 234 wouldn't be required to break through this level because there are only 89 supply here in comparison to 234. So you don't necessarily need more aggressive sellers than in the previous level to break through this level. And then we eventually come into a war of passive buyers. Same thing with the passive sellers, but this time a war of passive buyers. So they are defending this level and they are willing to supply 445 buy orders. So for price to drop through here, every single one of those 445 contracts has to be sold into. If the sellers can't do it, then you would anticipate the same thing that you would anticipate above here. For price to stall, potential bounce, and a reversal. But if they are able to consume all of these 445 buy contracts, then the markets will simply just move lower to facilitate any remaining demand with its existing supply at lower levels. So the market is an auction. Buyers and sellers constantly try to find an agreed price. And this is why order flow traders have an edge over traders who only read candlestick charts. The candle only shows you the result. The depth of market, footprint, order flow shows you the process. And once you read the process, you stop being surprised at what price does and stop questioning why price reverses at certain levels. Because you are looking behind the scenes to all of those moves that happens. You're looking behind the scenes of the expansion, of the reversal, of the accumulation, and you're looking at literal supply and demand, like actual supply and demand that moves the market. And that brings me on to the different cluster types. These cluster types, they portray the same information, but instead of showing you how many buy limits and sell limits there are, this is pretty much a historical tool, and it shows you how many transactions were successfully facilitated already. So, this is my volume profile, or my volume cluster, and it represents how many transactions were facilitated at specific levels in price. This is the most basic cluster type, and I'm sure a lot of you are familiar with this already, but there are many components. You have your value area high, you have your value area low, your point of control, and together, this range from the value area low to the value area high represents 68 to 70% of the total transaction within this candle or within the session. And then your volume point of control, that represents the single level where the most transactions were facilitated. And of course, you have your high volume nodes and your low volume nodes as well. But this is the most basic cluster. The next cluster will be able to explain order flow much better, and this is your bid and ask cluster. So on the left side are the amount of sellers who hit the bid, right? The amount of successful transactions between aggressive sellers and passive buyers. And on the right side is the same thing, aggressive buyers hitting the ask. So the amount of aggressive buyers who were able to facilitate a successful transaction with passive sellers. So going back to this example, right? If an aggressive seller was able to facilitate at 21049.75 and their orders were paired up with 156 limit buy orders, then this would show up on the bid and ask as 156, and that is representing a completed transaction. So that's what the bid and ask shows you. The larger the bar, the more successful transactions occurred at that place. And you can see, if you compare the bars side by side, how many aggressive buyers, you can see how much more aggressive one side was in comparison to the opposing side. Again, you have your value area low, value area high, and your volume point of control. Right, so that is your bid and ask cluster. Your next cluster type is your delta cluster. And this is one a lot of people will probably see when they first come across order flow. This is pretty much on every single chart, every order flow platform, etc. But what this essentially shows is the same as the bid and ask, but it's showing you the delta. What is delta? Delta is the difference between aggressive buyers hitting the ask and aggressive sellers hitting the bid. So all of these candles are the same, right? Like, these are all the same candles. If you look at the high over here, 15 aggressive buyers hit the ask and 3 aggressive sellers hit the bid. Delta, difference between the right side and the left side. Difference between aggressive buyers and aggressive sellers. And that is what you get here. So you have a positive delta of 12. And the rule of thumb is the more positive a number, the more aggressive buyers are in control at a specific level. And the more negative a number, the more aggressive sellers are in control at that specific level. And the core idea is, if buyers are dominating most of the level, the candle should close bullish. Price action should ideally continue higher. If we don't continue higher, then you have a potential problem. And that goes back to these levels over here, where you have a wall of buyers or sellers. But that is your delta cluster. It's showing you the difference between aggressive buyers and aggressive sellers at that single level. This is the same thing, but this is your delta profile. So this is a delta cluster, this is a delta profile. It's showing you the same thing, but this is just in a bar format, and it's giving you a clearer picture of how dominant was one side in comparison to the opposing. So the longer the bar, the more dominant one side was. Here, you have a delta of 90 in comparison to this miniature red bar of -2. So at these levels, you have a lot of aggressive buying dominance, whereas at this level, aggressive sellers were in control, but not so much in comparison to this -62 level over here. So those are the different type of clusters. And to conclude, it's showing you how many transactions was successfully facilitated at specific level. And certain cluster types will compare how many successful transactions were facilitated on the buy side in comparison to the sell side. And that is giving you a good picture of who is in control at those specific levels. Now you understand what those main cluster types are, they are still useless if you are unable to build context with it, which brings me on to these 3 concepts. And these 3 concepts are what separates someone who can read a footprint chart from someone who can actually trade with it. Exhaustion, absorption, initiation. Once you understand this, reading order flow will become so clear. So starting with exhaustion. Again, I am using the bid and ask profile. So how many aggressive buyers hit the ask and how many aggressive sellers hit the bid at a specific level. Exhaustion happens when one side of the market, buyers or sellers, starts running out of energy. The move is still happening and price is still going in the same direction, but the conviction behind it starts to fade. And this is what you see on the footprint chart, or your bid and ask cluster profiles. We have a dump lower, potential support level that we come into, but you can see that we have a lot of aggressive sellers here in comparison to aggressive buyers. If you just compare these levels alone, you had 123 aggressive sellers in comparison to 96 aggressive buyers. 128, 67, 43, 72, 116, 75, 122, 84. So for the majority of these levels, aggressive sellers were in control. We continue lower, we eventually come into some form of a support. Or it doesn't have to be a support, it can also just be a level where sellers are no longer interested in transacting at that level. But you can see that on the left side, aggressive sellers hitting the bid, the conviction starts to fade. These levels start to taper off. So where you had 216, 251 aggressive sellers, it starts to taper off significantly until you come down to the low of this candle, where there are only 29 aggressive sellers, 33 aggressive sellers, 41, and eventually 3 aggressive sellers at this level. So you can see that fewer and fewer sellers are willing to push price lower, and that is exhaustion. Now in this specific example, we get a reversal to go higher, but that exhaustion doesn't always mean the move will reverse immediately. It just means the move is losing its engine. It's your earliest sign that a reversal, or at a minimum, a pause is coming. Usually you don't act on exhaustion alone, but when it starts to happen, you should be wary of any trend continuation plays, because think of it like a sprinter. They're still running, still moving forward, but they start to slow down. They're not going to stop instantly, but they are clearly fading. And that is what exhaustion looks like on the footprint. The next concept is absorption, and this is one of the most powerful signals for a market reversal. And this is the main concept you're going to look out for on your footprint chart. So here is your delta profile, delta showing you again the aggressive buyers, the difference between aggressive buyers hitting the ask and aggressive sellers hitting the bid. Based on your depth of market and the teachings here at the start of the video, if you have a lot of aggressive buying that overwhelms aggressive sellers, you would anticipate for price to continue moving higher. Vice versa, if you have a lot of aggressive sellers in comparison to aggressive buyers, you would anticipate for the candle and price action to reward those aggressive sellers and continue moving lower. Going back to your depth of market, if however that doesn't happen, then there is a good chance we hit a wall of limit orders, such as 21051.25, 445 sell limit orders, or 21049, 445 buy limit orders, based on the direction the market is moving in. And when that happens, price will start to stall and aggressive buyers are no longer being rewarded with higher price action. The market has no reason to continue moving in the direction of that demand if the demand is insufficient in comparison to the supply. So that is exactly what you have here. You have a lot of aggressive buying who take control at these levels, right? 103, 84, 70, 146, 44, 42. It's clear that aggressive buyers are constantly in control at these levels. They are overwhelming aggressive sellers, and hence why you have these positive delta. But price is not moving higher. You'd anticipate for all of these aggressive buyers to get rewarded, but look at how the candle closes. Large upper wick. Next candle, fine, you get a movement, but you still come into a wall. You can't move any higher, and it becomes blatantly obvious when you look at the following candles. Aggressive buying, in control, but the candle starts to close bearish, and that is an absolute clear sign to you that over here, at this level, a potential level of resistance, there is a strong presence of passive sell orders. So what we could infer above here is the same thing we are seeing over here. We are potentially coming into a wall or a cluster of passive sellers, and the supply is absorbing all of the demand. So these transactions are being fulfilled, and there's a lot of demand for buying, but the demand is not enough to break above this invisible level of resistance. The reason why I say invisible is because on the footprint chart, you can't see your limit orders. But based on the candle structure and based on price action alone, you can infer from it, because this is showing you aggressive buy orders dominating, but we are failing to close higher. So that is your absorption. All of these aggressive buyers are being absorbed by passive sell limits. And again, if buyers are unable to reload with heavier demand to break above this supply level of passive sellers, then eventually you can anticipate a reversal, which is what happens here. So this brings me on to the third and final concept, initiation. And initiation is what a genuine move looks like on the footprint chart. So remember how I said, if you have a lot of aggressive buying, you would anticipate for the market to reward it with higher price action, unless it comes into a level of resistance. Now, remove that level of resistance, and this is what you get. You get your initiation. So one side is clearly aggressive, decisive, and meeting very little resistance. The bodies of the candle and the price action is rewarding the ones who are in control. And the delta is strongly in one direction. So where absorption is a wall, initiation, you could think of it like a vacuum. The aggressor is moving through the market and nobody is fighting them. This is also another example, but on the bullish side. So we come down, a lot of aggressive selling, in control, but they are not being rewarded with lower price action. So passive buy orders are absorbing all of these aggressive sellers. And as a result, price stalls here. It creates a level of support, candle closes higher, and we initiate higher. Initiation again, aggressive buying, candle is being rewarded. Look at every single level here. Strong positive delta. Buyers hitting the ask is dominating row by row with no significant bid side pushback. And price is moving cleanly higher without stalling at any level. That is initiating buying. And these are the kind of moves you want to be in rather than against. The reason these three concepts matter is because they cover every meaningful state the market can be in. A level defending itself invisibly, that is absorption. And a move that is losing conviction, that is exhaustion. So every trade you take, one of these three things is happening. Your job is to identify which one. But a sequence of things for the highest probability reversal scenario would be you start getting your exhaustion, right? Seller starts fading. It comes into a wall of passive buying. So even though sellers are fading, they are still in control, but they are not being rewarded with lower price action. And instead, we bounce higher, followed by initiation. So when you utilize those three concepts together, your reversals will become extremely powerful. Right, you've got the cluster types, you've got the three concepts, and now let me show you all of it working together on one real chart. So looking at the chart now, and just simply reading the tape, it will become so much more clearer to you. Here, this candle, we have strong selling into potentially a level of support. But either way, this was a level of reversal because we had a lot of aggressive selling that was in control, but the candle closes bullish. We didn't get rewarded with lower price action, which would mean only one thing. There were a lot of passive buyers in the form of buy limits absorbing all of these aggressive sellers. So like I said, the demand for sellers were not enough to overcome the supply of buyers. So price stalls here and we reverse with buying initiation kicking in. The secondary candle is the same thing. You have a lot of aggressive selling who was in control, specifically within this value area, but it was unable to regain control. So passive buyers are still playing here with aggressive sellers, with aggressive buyers starting to kick in and continue price higher. So this is a pretty messy example, but that goes to show that as long as you understand the actual definitions behind the concepts, you will have no trouble identifying what phase it is. If you look here, same thing, aggressive selling, no reward lower. You could assume this was a level of passive buying, absorbing all of these aggressive selling for price to continue higher. So the lifespan of the candle looked like this. We opened here, aggressive sellers took price lower, but they were unable to get rewarded with lower price action because there was passive buyers in the form of buy limits absorbing all of these aggressive sellers. So the market had no reason to continue and move lower. So then we get a bounce, aggressive buyers stepping in now, and that is initiating the candle to continue higher and close higher. Same thing for all of these candles over here. Absorption, aggressive buying, stepping in. It's pretty much like, it's textbook. Open here, we come down because aggressive sellers are dominating, pushing price down, but passive buyers are absorbing all of these orders. So they have no reason to continue lower if there is enough supply to sustain the selling demand. And instead, we get a bounce, aggressive buying, stepping in now. And then if you look at the next candle, this is also a sign of exhaustion because you have a lot of aggressive buying here, but then it starts to taper off at the high of this candle. And this is a good example of what I said previously when I said exhaustion typically isn't enough to define a reversal. Because this just means buyers were losing steam, but that doesn't mean they lost control. They were just losing steam, and price had to potentially make some sort of a pullback into a possible reload area where aggressive buyers are able to step back in again with strong demand and continue higher. Because it also goes back to the market phases. It can't always continue in an expansion, uptrend or downtrend for an unlimited period of time. Eventually, they will always have to pull back to test lower levels and reload on their demand. So that is what you had here, exhaustion, but aggressive buyers were able to step back in again until we eventually reach some sort of a wall, right? Exhaustion above here, with aggressive buyers fading, aggressive sellers start to take control, aggressive buyers dominating this level, but price fell to move higher, and instead it closed lower. So that means not only did we have exhaustion above here, but these aggressive buyers were also absorbed, and we have a potential pullback lower. This is only a pullback because our overall narrative is still bullish, but you could see that in this pullback, it's giving you signs of when the pullback is going to stop, just from these candles, right here. If you was trading a normal candlestick chart, you probably would have seen this. So if I void this, this is what you would have seen, right? You have no idea, even after this bullish green candle, it would be too risky for you to anticipate the pullback ending right here. You would think, you go lower, this green candle was just a pullback within the overall pullback to continue lower. You don't have clear evidence of price actually completing that pullback until it breaks above this swing high. Then that becomes your break. But by that point, you would have already missed this move. With order flow, you can see everything that's happening as we approach the end of the pullback. You have a lot of aggressive selling here. When you have a lot of aggressive selling, what do you anticipate? Like, this candle is so much. You would anticipate for price to continue moving lower unless it hit a wall of support where there's a lot of buy limits absorbing all of these aggressive sellers, which is exactly what happened here. Same thing, next candle, a lot of selling aggression, but we fell to continue lower. A lot of passive buy limits are absorbing the demand of these sell orders, and instead, this candle closes bullish and we continue higher from here. Secondary candle. If this wasn't enough for you, looking at the secondary candle, it's the same exact thing. Aggressive sellers tried to take back control again after it failed previously, so we tried again the second time. But again, it failed. Aggressive sellers were absorbed, aggressive buyers stepped back in and pushed price higher. So based off these two candles alone, you would have already anticipated for the end of this pullback to continue higher. And from there, you have your initiation, 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 until, again, another level of resistance. Exhaustion coming into play here, with buyers starting to fade out. And all of these buyers, despite having control, they were unable to bring price higher. So exhaustion paired with absorption is a very strong combination, because that means buyers ran out of steam, and any buyers that were able to hold control were all absorbed. So that is a complete dominance of buyers from sellers. All of these buyers absorbed, selling steps in, further absorption of buyers, candle closes bearish. And that is the play of passive sellers here, fully absorbing all of these orders, and we continue lower. As you can see here, the next candle, sellers were unable to initiate lower, and instead they get absorbed. And this is where you really want to lock in and see who is actually in control with those following levels. Because if buyers are able to absorb all of these sellers, with initiation kicking back in, and we break above the previous level of buying absorption, because here, strong presence of selling limits, then there's a good chance that there is enough demand to overcome the supply of sellers at this resistance level. But as you can see here, they fell. We come back into this level where there was a strong presence of passive sellers. Buyers were absorbed again. Selling initiation were able to kick back in. Aggressive buyers were not able to take control at this candle, and we continue lower. The next candle, aggressive buyers are present again, taking control at these levels, but failing to take price higher. So now that is a very, very strong signal for selling absorption and continuation lower. We come into yet another level of support price retraces. But see how I mentioned that this is a strong level because this was where it's proven to you that it had a presence of passive sellers, because there was zero reason for these aggressive buyers to not get rewarded higher unless there was a big sell limit hovering around at this level. So when price comes back to this level, you would anticipate for passive sellers to step back in, which is exactly what you get here. And it's almost textbook because it's the same thing that happened here to here. A lot of aggressive buying, but all of this demand was met with sufficient selling at a previous level of passive selling. So they all got absorbed and we continue lower. Initiation kicks back down. Retracement, a pullback here. Similar example to this pullback over here. You can determine when the pullback is likely to end. And this is exactly like so. We come into a level of potential resistance for the pullback to end. Aggressive buyers absorbed. Selling initiation kicks back in and we continue lower. And that is the exact process behind reading order flow with your footprint chart. It's extremely simple and it doesn't have to be overcomplicated because the core principle always goes back to basic supply and demand. Is there enough supply to fulfill demand? If there isn't, then the market will move. If there is, then the market has no reason to move. So all the order flow tools, they just tell you the same information but at a different angle. So if you enjoyed this video and you found it helpful, make sure you like and subscribe, and I will see you in the next one.